Good morning, good evening, good afternoon, and welcome to another session of Bizarre Financing, how to start, buy, or expand any business with little or none of your own cash. Today, we're going to show you one of the projects that we're working on right now. And in that process, you'll get a sense of how a small company can buy a much larger company, literally 7 times its size. And hopefully what you'll take away from today is that two things. One is little guys can buy big guys. And the second thing is that if you once get yourself a small company, you can use that company to buy a much bigger one. There's a process here that can actually be very helpful to you. The small one kind of gets your arms around the business and the industry, and maybe it's something you feel like you can handle, but then it's really a small leap from that point to where you can actually acquire a much larger company using that smaller company as kind of the base for that. So let me get into this. I also answer questions, so I'll be here to answer questions when I'm finished with a lot of the presentation here. And if you have questions, type them into that side panel question box on the side. That way you'll have them up and ready to answer. If for any reason you'd like to actually speak and have me dialogue with you and answer questions in a give and take type format, happy to do that. Just raise your hand. We'll turn your microphone on. And then any questions that you don't have answered today, just send me an email to question@bizarrefinancing.com and happy to answer it that way as well. All right. So here we are. How can a small company buy a large company 7 times its size? It's all in the math, as you're going to see, because I'm going to take you through an Excel spreadsheet that we've developed for navigating this entire process. And what that does is it reduces it all down to the math that makes it possible. But in order for the math to work, you need to have some definite concepts behind what you're going to do with that math. And one of it is financial leverage. In other words, how do you make a very small amount of dollars do the work of a whole lot more dollars? And it's a process of financial leverage. There are several elements to it. I'm going to cover them with you today so that you can see exactly what they are and how they work. The next part is brilliant strategy. Okay, so if you have a great process or method, but you don't have a strategy for how you're going to make it happen, then the chances are it'll never happen. It'll just be a great idea that sits on the shelf somewhere. So we're going to talk a little bit today about a brilliant strategy that helps you put this into play. And then masterful techniques is another one, okay? We're going to cover those with you today as well. So you can start to see the actual techniques that enable this whole strategy to work and apply financial leverage to the acquisition of that much larger company. And then the last element that I'm going to cover with you today is something you've heard me talk a lot about. It's called cosmic bond. And people tend to do business with folks that they like, trust, and respect. And so you're going to want to build a relationship with everybody that's part of this process where you like each other, trust each other, and respect each other. Because if you can build that cosmic bond with each of the players, then you're going to have a lot of support in getting this done. And one of the nice things about our Bizarre Financing Pro program is we get into all of these in excruciating detail and step everything out so that these things are easy to understand and, more importantly, easy to follow. But let me cover it for today. A lot of folks that are here today are really at the early stages of buying a business or looking to get into business. Others are here and much more advanced. Some of our pro people are here as well. And so those folks have a little leg up because they have a little bit deeper level of understanding of all this. But even for those of you who have just been through the Bizarre Financing Essentials program, you already have enough of an underpinning now that I think you should understand everything I'm going to go through today, and that these are pieces in here that have great value that you're going to want to apply to your methodology for acquiring a business. Okay, so before we get into the questions, the first thing I want to do is take this off the screen and put up an Excel spreadsheet, which will be the essence of what it is that we're going to cover today, because embedded into this spreadsheet is all the math, all the methods, all the strategy, and all the techniques that are necessary to do this. And it's designed to track them all and enable you to quantify them and then apply financial leverage to making the acquisition work. And what I'd like you to notice before we get too far along here is that there's a bunch of tabs at the bottom here. I'm just scrolling over them now. So you can see all these tabs down there. Each one of these tabs is a separate worksheet, and they interrelate to the other worksheets in order to make happen what's going to happen here. Now, there's even more of these than you can actually see here. For example, if I scroll them over a little bit, you'll see there's a few more down the end down here. And all of these are going to be working together and making this process a lot easier once these kinds of sheets have been developed, because it lets you track everything and account for everything that really needs to happen. So what I want to do is to actually start out on this first sheet here, because you'll notice that the tab that this is on says results. And the reason that I'm starting out here is I'm starting at the end so you can see how it ends up. And then I'm going to go back to the beginning to show you how it all gets developed. And by doing that, I think it'll help you to have a much broader and much deeper understanding of the process. Okay, basically we have two companies that are involved in this. One is the buyer and one is the seller. And to make it easy to follow, this is an actual worksheet, by the way, from an actual deal. The only thing I did is we obscured the names to protect the guilty. So you'll see company sell is over here. That's the seller, selling company. And company buy is over here. That's the company buyer. So anywhere where you see something referenced as company sell, there was an actual company that had a name that actually went there. And wherever you see company buy, there's an actual company and their name is in effect there. So let's go over the two different companies and I'll show you how they relate to each other. First of all, they're in the same business. It helps that these companies understand each other's business pretty well. And the other thing you should know is that this company, which is much bigger, is also much older. And it's owned by somebody who is at an age when retirement is really important to them. This is what they want to do. They figure they've got another 2 or 3 years that they could be active, but they know that this is something that they need to deal with because they need to turn this lifelong production of a business into actual cash in order for them to have financial security as they've gotten older and can no longer deal with the rigors of trying to build and run a business. On the other hand, over here, the smaller company is much younger, is owned by somebody who's really got his act together, understands the business really well, is looking to grow, realizes growing by acquisition is the best way to accomplish that, and is looking to take and leverage the company that he has into the ownership of a much larger company. And this is almost a marriage made in heaven because the two parties have a reason to build a cosmic bond with each other. Here you have an older person whose motivation is to sell and retire and be financially secure. Over here, you have a younger buyer who wants to build and grow and would love to own this other business to include it in his platform for future growth. And so the two folks have a reason to be together. They have something in common. They are in the same business. This party can look at this party, as you'll see, as a person who is not just new to the business, but he's a growing party in this business. He's proving that he knows how to run this kind of business and really make it grow. So this party can respect the fact that this person has already accomplished their objective, but did it in a prior era. And this person can respect the fact that if this person owns the business, it's going to be in the hands of somebody who understands the industry, shares their values in terms of the business, and will be a party that will be successful and make their company grow. So we're able to build a bond between these between these individuals, companies, that they get to build that cosmic bond and learn to like each other, trust each other, and respect each other. So I want to make it clear that this is something that always, in my view, precedes the math, because if these two folks didn't like each other, it wouldn't matter what the math was. One of them would find a way to kill the deal, even if it was going to happen. So by having them both on that same parallel, it's like being in love. When you're in love with that gal, or that gal, you're in love with that guy, you don't see their flaws. You only see the brilliant future ahead, and that's the mental condition that you really want to have both the buyer and the seller in, where they're looking at each other, they really like, trust, and respect each other. They're putting aside each other's flaws to focus and to emphasize the positives of getting together. So the psychology is right. The psychology of the transaction is right. So hopefully you understand that part of the process. And so once you get past that, now the math will start to make sense. Okay? So let's look at this particular company and try to understand it just from the simple facts that we see right here. Okay, if you look at the transaction value, we had to come up with a value for this company, and what would its value be? And you see a number there, and what does that number mean? As you'll see when we get into the earlier parts of this worksheet, we calculated all this. And when we did that, we found out, or we came up with a reality that this company value was 6.3 times EBITDA. Okay, EBITDA is earnings before interest, taxes, depreciation, and amortization. It's a measure of the cash flow creation capacity of the business. And so one of the ways that businesses are valued is by multiples of EBITDA. So if the EBITDA was X, then in this case, we're saying that the value of the company would be 6.3 times X. So if we look at that number, you're going to see it equals 5,111,000. Okay, 5,111,000. So if you want to know what the EBITDA is, and we're going to show it to you later, the EBITDA right here, in fact, it's right here. Okay, this is pulled from an earlier part of the worksheet, where the EBITDA of this particular company is 811. And that's what its earnings before interest, taxes, depreciation, and amortization were deducted. That's what it was. The sales of the company for the year, now you'll notice it says 2022. These are foreign companies. One's in Australia, one's in New Zealand, and they don't have the same year ends that we have here. They end their years a little differently. So even though it says 22, we already know what those numbers are. Okay, so the company's sales were $4,065,000. Their earnings before interest, taxes, depreciation, and amortization was $811,000. I don't know if you can see this real well, so I'm going to blow it up just so you can, okay? All right, so now, and so the net profit, which is different than the EBITDA, okay, was $608,000. Now, this includes the interest, taxes, depreciation, and amortization. Those things have all been deducted, and that's why you get a lower number here. Okay. Now, companies are priced two different ways with respect to their earnings and their cash flow. Okay. What we did is we did a bit of research on this particular industry, and we found that there are what are called small cap, in other words, companies that aren't the giants. They're smaller type companies, but they are publicly traded, and they tend to trade at a certain multiple of their net profit. Okay, that's the way public companies are priced. You've probably heard it called the PE ratio, or the price earnings ratio, or the price earnings multiple. It's an after-tax number, which is what this net profit is right here. This is their net profit after they paid their taxes. And in this particular industry, they average in that marketplace about 10.5 times, these small cap companies, 10.5 times their after-tax net profit. So what we did is we wanted to put a value on this company, on what is our buyer actually worth as a business. And it turns out that if we apply this multiple here, okay, we can't apply it directly because this company is not a public company. The public company is always going to be worth a higher multiple of earnings than a private company, because there are certain things that are true for a public company that are not true for a private company. For a public company, your stock is liquid. Okay, I can take my stock to a stockbroker and I can have them sell it for me. There's a marketplace for the stock. So at a certain point, my stock will be sold into that marketplace at this multiple of earnings, roughly right here. And I can turn my stock into cash actually within 8 to 10 days. I'm going to have a check in my hand. I can't take any portion of my business as a private company and do that. So the company doesn't have liquidity. It's already of a size where it has, that company's public is going to be a whole lot bigger than this company. So it's got depth of management. It's got all of the features of a company that make it much more stable, much more viable, and it's got liquidity. So whatever the multiple is here, the private company is going to be not worth as much. And as a rule of thumb, generally, a private company will be something at least 20% less valuable in terms of this multiple right here than it would be if it were publicly traded. This is a rule of thumb. There's lots of reasons why this percentage can be different, but when you apply this percentage to the 10.5 times multiple that's a public company, that would be what a private company would basically be valued at. Now, arguably, this could be 8 times. It could be 7 times. It could be 9 times. It's not going to be 10.5 times. It's going to be something less. And so this is relatively an art form number here. It's not science, but it's a good indicator that this company would probably be valued at somewhere around 8.4 times this. All right. If you wanted to get that same value as a multiple of EBITDA and end up with the same value based on the EBITDA amount, also a 20% deduction, you would get 6.3 times EBITDA. All right. So our system is set up to run off the EBITDA number. So by putting this number in here, we get this number here as its value. Okay, because what it does is it takes what is earlier the EBITDA of the company was established. We're going to take you back there and show it to you. But we take this number here, it's multiplied by 6.3 times, and that's how we get this number here. So this is its valuation as a private company, and for our transaction that we're going to do with this other company, we're going to show our company, that's the buyer company, is worth approximately $5,111,000. So hopefully everybody understands the concepts here, that we, in terms of coming up with the price of a business, there are two factors that we want to look at. One is EBITDA, and the other is net profit after tax. There are multipliers that the public marketplace sets that we're going to track on in order to interpolate the value of this company. And in this case, if we use a value of 6.3 times EBITDA, we're going to come up with something that's around 20% less than this company would be priced at if it were a publicly traded company. And so we know we're somewhat in the ballpark. In other words, we have an authoritative basis for coming up with this number. We didn't just pull it out of the sky because the owner thought that's what the business is worth. All right. So this is how this happened here. All right. Now, interestingly enough, the company has a growth rate, and the growth rate is the growth rate of 1923, what they're forecasting for 23 over 22. This the year that for them just ended. And we took a very low growth rate, which was actually below what they projected to be conservative. And they felt we can increase our sales at least 7% this year, hands down. Okay, if they did that, their sales increase would be this 284, 599 here based on that. So this gives us a rough idea of, this came from history of the company up here. And we have this down here, which is telling us a little bit about where management was confident they could grow this company even more, okay? And that they could add another little over $250,000 to sales this year, minimum over last year, okay? So this is our buying company. Now let's go through the same kind of setup here as to what came up when we went through this whole entire sheet. Remember, we went through all these things down here to get to this, okay? But here's where they got us to, okay? This is the selling company. And what we did is we went through the same mathematical process that we went through for our buying company. We did the same thing with the selling company, right? And so here, our basis for this was they had gross sales of 20 million, and you'll notice that's about 5 times the size of the sales here. They did EBITDA of 3,360,000. So that was their earnings before interest, taxes, depreciation, and amortization. And their net after tax profit was roughly 1,971,750. Okay, so that's their history. That's what they did this last year. Okay, now how does that work in terms of a transaction value? In other words, how would we come up with a price that would measure the value of this company? Again, it's the same industry, so it's the same public market for public companies. They sell on the public market at 10.5 times net after tax profit. Okay, so we don't want to pay more than that for the company. That's for sure, okay? Because if we did, we'd be paying more than we would be if they were a public company. All right, now this time we came up with an EBITDA multiple of 6 times earnings, 6 times EBITDA. And so when you take that number and you plug it in, that's how we got the 20 million up here. 26 times this number right here equals this number right here. The valuation as a private company isn't that number, okay? Because this company is older, it's more mature. The individual who was running it has been fading into retirement for at least the last couple of years. So they haven't been as astute, they haven't paid the attention, they haven't done the things that promote growth the way they would have if they were younger and energetic, which is all part of the reason, the rationale as to why they're selling is because they're realizing they can't run this business with the same energy and the same drive that they did to build the business in the first place. So the company is not growing at the rate that it would be growing if these individual was a young entrepreneur really fighting to build up the business. So you start to see why the two principles of these two businesses are made in heaven for each other, because one, they both need each other in reality. The younger guy needs this as a platform for future growth, and the older guy needs this because he can't run the business at the same effectiveness that he did in the past, and it's time for him to move on and retire and enjoy those later years with the wealth in cash that he's created all of this time. Basically, when you go through the same math up here, okay, at 6 times EBITDA, this would be the value. But you'll notice it's pushing the value of a public company, which means you're really overpaying for this at the 6 times EBITDA number. And when we get to 6 times EBITDA, we had to compromise between two things, okay? One is the value that the seller is delivering, okay, which is a certain amount of EBITDA and net profit, versus if this young guy is now running this business, he can take this platform and do a lot more with it than the seller can. So somewhere in this process, there's an accommodation that makes it okay to overpay for the company because of what the buyer can do with it versus over what the seller in the last few years did with it. So that's part of the rationale. I'm not saying these numbers are a science of getting to these numbers, but I wanted you to understand where they come from and why these adjustments are okay. Okay, you can afford to overpay a little bit for its actual value because its actual value really is higher because of what you can do with it. Now, as a matter of policy, you don't want to pay for something more than what the seller did with the business. But at the end of the day, you can pay a little more because of what you're going to do with it. So that's built in here. All right. Now, what this all is telling us is the kind of the ballpark that this is all going to operate in. And then we get to something that we would refer to as, okay, what are the terms of this purchase going to look like? Okay, we have a purchase price, and this is based on a model where the buyer is going to acquire 100% of the selling company, okay? And the purchase price is this number up here, and it's basically divided into 2 parts, okay? One is that there is a kind of cash on close, which means there's a certain amount of cash that the buyer is going to provide to the seller, and they get that money when the deal closes, okay? It closes, that's cash that's going to change hands. The balance is going to be on a seller carryback note, which is going to be for $5,160,000. The interest rate on this note is going to be 4%. It's going to be amortized over 60 months. So the payments are going to be $95,029 a month. Number of years, 5. And there's no retention of any of the company. In other words, it's 100% sale. They're not going to sell 75% and keep 25% or anything like that. It's 100% sale. So this then is the final buyout over here, cash on close, monthly payments, which is 60 times this. So the seller on a buyout of this amount is actually, the seller is going to get this amount because he's going to get interest over that period of time, which is the difference between these two. So this is the payments on the note, the 60 payments. So here you've got the whole picture of the cash that's going to change hands. Now you and I both know that this buyer doesn't have $15 million in cash to give this guy. We all know that. So in order for this deal to happen, that cash is going to have to come from someplace. And all these other pieces down here, okay, is how we were able to figure out how we could come up with this $15 million that we needed to buy this company. All done through strategy, techniques, methods, strategy, of course, right? Okay, all that comes into play with all of that other. So now I'm showing you this. Why? Because from where you sit now, it'd be easy to ask the question, this is all great, Bizarre, but where do you get $15 million? This guy over here has a company that's only worth $5 million, remember? Okay, so if we look at it over here, this individual only has a company that's worth $5 million, and that's at a multiple of its earnings. He doesn't have those kind of assets in the company. Okay, so how are we going to do this? How are we going to do this? Okay, we're going to get there, okay? But I wanted to show you the outcome first so that you could identify that, all right? And that's the important part. Now, also, when we went through all these numbers down here, we actually came up $4,102,000 short of the amount that's necessary to do that. So in here, you're going to see how we overcome that problem too. So in other words, in many of these things here, we were able to generate $11 million cash, but we were still short. We have to come up with that, okay? So again, I wanted you to get the overall picture here. These don't matter because we're not doing a partial buyout. These numbers would be populated here if we were doing something like buying 70% and the seller was keeping 30%, and then eventually we buy out the other 30%. All that's not happening. We're buying them out 100% on day one, all right? And by the way, he's still going to stay with the company. He's still going to work to help it grow. And the difference is he's not going to have the pressure of having to be the driving force in the company. Somebody else, the buyer, is going to be taking over that role. Just from the standpoint of other items on here that I don't want you to look at some of these things and saying, what does that mean? So I'm going to describe them to you. FYE just means for the year ending. So if you see that abbreviation, that's what that means. GR means compound monthly growth rate. So in other words, any given month, how much is this company going to grow? That's based on numbers you're going to see developed earlier in these sheets down here, that we figured that about 5% per month. So that's roughly about 6.44% per year, okay? So that's how that comes out. Why 6.44%? Because that's what the company grew at in the past, okay? So that's how we got this number here. And then we just interpolated it forward if that's their history. We believe we can make the company grow a lot faster than that because we have a new energy source that's going to be coming in that knows how to drive sales and build up this business, okay? So now you got the picture of both sides. Got kind of the picture of both sides. And maybe before I go on anywhere, let me ask you if you have any questions, but I don't want to take the questions as written questions. If you're going to have a question, I want you to raise your hand and I'm going to call on you. So because what happens on questions is I need to be able to make sure I'm understanding your question, and I can only do that if I'm speaking to you. If you have any questions that you'd like to ask just at this point of what I've covered so far, just raise your hand and I will call on you and I will open up your microphone and you can tell me what your question or your thoughts or your comments are. Anything you want to talk about is good. All right, I'm not going to wait long, so if you got a question, definitely put up your hand. I see a written question here which says, oh, please enlarge the Excel spreadsheet. So why the 20% discount on the multiple, and how do you explain to the owner? It's real simple. He's not a public company, okay? If the reason you apply a 20% here, if I can buy stock in a publicly held company because its value is 10.5 times the net profit, I can't buy and sell the seller's stock in the marketplace. And he's not, in other words, this company might be a $20 million company, and they have maybe some decent management people in that company, but they're not a $100 million company that's got depth of management, that's got diversity of product, that's got all the things that much bigger public company has. They cannot command that multiple. And you'll find that this multiple company over here is not growing at 6.44% per year. They're growing at 10% per year, 15% per year, in some cases 18% per year. A company that's growing rapidly is going to be worth a whole lot more than a company that's barely growing. or maybe even going backwards for a year or two. So there are lots of reasons why they do not command this multiple. And frankly, I would have no problem arguing that only discounting their value 20% from a publicly traded company is being very generous. The typical private company does not sell for 80% of what a public company sells for. It's going to be more likely 7%, maybe even 60%. It's not going to be close to what the public company is worth. Okay, so that's basically the argument for that and how that's handled. Okay, last chance for a question. Now moving on. All right, we're moving on. So let's do that then. And now the question is, how did we get to all this stuff? Okay, let me start down the other end with public stock. Okay, so what we did, this particular companies are in the seed industry. And so what we did is we went to Yahoo and to some of the other websites that quote all this stuff. And we found out what their PE ratios were. So this company was 10.27. This company's 10.11. This is all times the earnings of the company net after tax. And so this one was only 7.49. So you see, we didn't even go down here. We didn't even go here. We went with a rounding out of these numbers at 10.5. And so we were very generous in terms of the PE ratio. And one of the reasons we do that is so we don't get an argument from the seller. We don't want the seller saying to us, you aren't really crediting me with what the industry really commands. We have every argument to how we've been generous with that. And if we do get that argument from the seller, we'll go back and do more research to go company by company and say, here's this, and show absolutely that we've been generous. And we like being a little on the generous side because nobody makes money in these deals on the edges. You make money by getting deals done. And so we don't want to trade on the edges. We want to be a little generous in every one of these areas so that we can just get this deal done. All right, the next thing that we had to do was we had to come up with a compound monthly growth rate set of tables. Now, why do we have to do that? We have to do that because we got to know at a given growth rate, what are the factors that are going to tell us how much that company should produce each month going forward if their compound monthly growth rate is a certain number. So here we have a table that was constructed that shows the rate per year of a compound monthly growth rate of 1%, 2%. This is rate per year. 1%, if a company's going to grow 1% per year, how much does it have to grow monthly in order for it to achieve 1% growth by the end of the year if each month is compound in the months for the month before it? Okay, so what we found is that this was what it would have to look like, right? So if your base earnings is $1,000 and you're going to grow at a compound annual growth rate of 1%, then the end of the first month, you're doing 1,000.83 in sales. If the base rate the month before this was 1,000, so this is the amount of sales that you would do each month until you get out here to the 11th and then 12th month. The 12th month, guess what? You had your 1% growth based on this compounding effect. Your 12 months of growth equals 110%. So this is the amount you had to grow at in order to do that. This is the monthly rate that enables you to do that. And this is a factor that we can apply in our future pages that we're going to show you that enable us to calculate all of this stuff and know that we're correct. Now, the problem is we had one company that grew at 6.44%. So we had 6% on our table and 7% on the table. So for this one, we had to construct a special table in order to identify at 6.44% compounded annual growth, what did the future have to look like? And so we did that so that we could accurately apply the same type of factors for this company doing 6.44 as we could for a company that was close enough to these where we could just use one of these. If this was anything but in the middle, we wouldn't have done this. If it was close to 6, we just would have used 6. If it was close to 7, we just would have used 7. But it was pretty much right smack dab in the middle. All right, so this table here is going to allow us to calculate what the compound annual growth rate is when the rate per year of growth is these numbers here. All right, next, we have to look at these companies and we have to identify, let me jump ahead a little bit here. Okay, we had to undertake some assumptions about each company. In other words, what do these companies look like? What are their key attributes that are going to weigh on two things? One is valuation and the other is value. In other words, value in terms of their worth and then value in terms of what can that worth be converted into in the form of cash to leverage that cash and that worth in order to make it part of the money we can get a hold of in order to buy the company. And we have two factors. We have the factors of the company that we're going to buy, and we have the factors of the company we already own. So we're going to have to look at both of them. So we start here with the assumptions about the buying company. This is the company that's going to actually do the purchase. So the company had $350,000 of cash in the company. It had accounts receivable of approximately $600,000. It had inventory of approximately $650,000, and it had equipment, a moderate amount of equipment that was worth $3,350. So these were the assets that were in the company. Now let me make this a little bit bigger so you can see it. I'm sorry I didn't do that earlier. Okay, so these are our values. Okay, and we say value for financing because this is what they're worth, but you can't borrow 100% on these assets, right? Now your cash is worth 100 cents on the dollar, but if you have accounts receivable, you can borrow in today's marketplace around 75% of that value. On your inventory, if it's done properly, you can borrow approximately 600. On real estate, if we had any, you can borrow about 75%. On equipment, you can borrow about 65%. Based on these values, there's financing available of these numbers right here. 450,000 can be borrowed against the 600,000 of assets, and 650,000 of inventory. You can produce another 422,000 of capital for there, cash for there, and then the same thing with equipment, 2178. Now, this is what can be borrowed, but if there's any existing debt, that has to be paid for if you're going to borrow against these assets. Now, this particular buyer didn't have any debt on any of these assets, so the net financing available was the full amount of the availability, right? Now, when we do this transaction, what cash or capital do we want to get a hold of that he's not using now? We're going to finance these two assets here. This one's too small. In other words, it doesn't pay for us to worry about this. It's just too tiny. Money could be raised here, but it's just not worth the effort. So we have post-acquisition debt we're going to owe when this deal is done, because we're going to borrow this money, of $450,000 and $422,000. So that's going to give us $872,000 of capital we're going to need to buy this company. There's going to be a cost for this money. This is roughly our marketplace that we're looking at. So on this accounts receivable financing, it's going to cost us 9% per annum. And on this $422,500, it's going to cost us 7.5% per annum. Now you'll notice there's no amortization on these loans, okay? Whereas if it was real estate, we'd be amortizing that over some number of months. We would change this if it were different, because this is typical. If it was equipment financing, generally I can finance that over 84 months. And if it's vehicles, I can generally finance that over 60 months, all right? But we don't have any of these, and these, it's not showing any amortization. And the reason is accounts receivable and inventory financing is what's called evergreen types of financing, evergreen financing. Why is it evergreen? Because you don't have to pay it off, okay? Because you create a sale, you create a receivable, you finance the receivable. Then it gets paid off. You got to pay off the receivable. But at the same time you pay off that receivable, guess what? You just put more sales out there, right? So the sale you just put out is what pays off the sale that you are now having to pay back on. So as you're collecting your money, you're also creating new sales. So your level of accounts receivable actually stays around the same, right? You don't pay it off, okay? So once you borrow against the receivables, they just keep rotating at that level. And in fact, if you're growing, the amount of available credit you're going to have is actually going to go up, not down, because you're creating more sales each month than you did before. So it's called evergreen financing. The same thing is true of inventory. You sell off your inventory, but then you buy more, and you finance the one you just bought as you pay off the loan on the one you just sold. And again, these are both evergreen financing, so there's no amortization of those loans. Hopefully everybody understands that, and we can move on here. So these are the monthly payments that we would have to deal with here. There will be payments here, but it'll be interest only. And if we were dealing with these units here, we would have monthly payments of principal, and they would be depreciation on the equipment that we just bought, and they would be depreciated over a period of time. And that's just necessary because we're going to calculate the depreciation in here because it's deductible for taxes, right? So there's a whole business model that has to be built into this that accounts for everything from taxes to everything, because we got to come up with what the final numbers are going to be for these companies. And this is the available depreciation from before the transaction is done. In other words, we're taking two companies that already have equipment and have either real estate or have some assets where we are going to have available to us some of the depreciation going forward that was not fully depreciated in the past from things they already own. In this case here, it's about $1,340 of depreciation that this company is going to have going forward from this equipment that they already own, okay? So hopefully that answers that question, or would answer that question if you had asked it, all right? And then the additional financing available to us over and above what they would already be financing, but they're not, right, because they didn't borrow anything, is the post-acquisition debt in this case. So $872,000 of our $20 million that we need to buy this company is going to come from the assets financing the assets of the buying company. Okay, so hopefully everybody sees that, and that pretty much takes care of that. Okay, moving on. Okay, we now have, let me back up a little bit. Okay, that was the assumptions of the buying company. Let me go to the assumptions of the selling company. Let's see what they look like. Okay, here we have let me make this bigger. Okay, so now we have the company that we're looking at here, which is the selling company. What do they look like? First of all, remember we had the seller is going to carry back some of the financing. Remember that? So when we showed you that other sheet, we showed that we calculated that we want the seller to carry back a certain amount. Here is that amount plugged in here. So a portion of our buying price is going to come from the seller taking a note for $5,160,000. It's going to get 4% interest on the note, and so that goes into where some of the money is going to come from. The company's got cash or equivalents in it of $3,782,000. It has accounts receivable of $3,468,000. It has inventory of $9,313,000 and real estate of $6,019,000. Okay. If we look at how much we can borrow against these assets, those cash, the carryback's 100%. That's seller's full amount of what the seller is going to carry back. The cash and equivalent is $3,782,000. Okay, we know that money's there and no discount against it. The accounts receivable, we can only borrow 75% of that, so that's $2,006,000. The inventory, we can borrow 65% of that, or roughly $6 million. And the real estate, we can borrow 75% or $4.5 million. Now, this particular seller doesn't have any debt against any of this stuff, but he does have a mortgage against the real estate of $1,234,000 that if we want to borrow this, we are going to either pay that off or get a second mortgage on the property, one of the two. But there's roughly 75% that we can borrow. We've got to pay back $1,234,000, so the net is $3,279,000. So this is what's going to happen post-acquisition to the numbers that you see over here. Now you'll notice that we show the sellers in full. We show nothing on the cash and equivalents. Why? We really want to keep this cash in the company to use as working capital to build the company. You got a company that's doing 20-something million a year in sales. You can't run a company like that without having cash on hand because things have to be done, payrolls have to get met, money doesn't come in evenly. You have all this stuff going on. You got to advance money to place orders for product or whatever it is that you're going to do. So we need a certain amount of cash in the company. So we at least look at this as we don't want to use that for right now. And then we have accounts receivable. This is what we're going to finance here and so forth. So we have the ability to come up with $11,905,000 roughly. So if we look at the additional financing available, we take the amount of post-acquisition debt, okay, but we do have to pay off this existing debt over here. So we end up with, and this number, I don't know if this is exactly what the number that we're looking for here, but we're going to have access to this 10 million of capital here to do what we want to do. All right, so now moving along over here, we have these interest rates that we've got to pay on these amounts of money here. We've got an amortization on a new loan here of 240 months. So this is the amount of payments that we have to make to the seller in both principal and interest monthly over the next 5 years. Okay, and we have to do this here for these payments here are going to be roughly $40,000 a month, right? And so there's also available depreciation for us on that land and building over there. So that's still $2,106,000 of depreciation left that we'll be able to take advantage of. So these are basically what the two companies look like, all right? And again, if you have any questions, I would invite you to ask them now, because at least now you've got a picture of the buying company, you got a picture of the selling company, you've got a picture of all the elements that are really going to be utilized here in the process. And if there's any questions you have, I'll be glad to address them. I'm not saying, oh, where can you get a copy of this? You can't, okay? And the reason for it is that these numbers are proprietary to certain companies and we don't want to just give them out. But hopefully you will get a recording of this because it'll be on our website, and you can go back through these numbers as often as you like. You can take screenshots if you want so that you have copies of what you see here, but we can't give you copies of the worksheets because they are proprietary and we don't give those out, but you can at least take copies of what you see here. And if you didn't catch them here, when you do the replay of the recording, you can take screenshots then. So in any event, don't worry about not having them. Okay, so anyway, that's that. I don't see anybody raising their hand. You guys are all shy, man. Shy. Come on, talk to me. All right. So hopefully we've got that. All right. The next thing that we got to look at here is, let's take the real estate, okay? Because we do one of these for the equipment. We do for each company. We do one of these for the real estate of each company. We do one of these for the vehicles of each company if they would have those things. But let me take the real estate so I can show you the seller's real estate. Okay, so let me do this. All right, so what we do here is this is a pro forma of what's going to happen with the real estate. And the reason we lay it out here is because we have the capacity to add real estate year by year, actually month by month, depending on whether the real estate is an elastic demand of the company. Here's what I mean by that. This particular real estate is enough to handle the needs of this company's growth until it's 3 or 4 times the size it is now. So no matter how much it grows, it will not be buying any more real estate. If the real estate was tied directly to sales, in other words, if in order to sell double the amount of sales, they had to have double the real estate, then all of these other numbers would start to come into play because the company would have to be buying more real estate as they go forward. So if I want to know the cash flow capacities of these companies as they go forward, I would have to know that more real estate is going to have to be bought. And if the real estate is bought, it can only be financed at 75% of the cost of the real estate, which means I'd have to come up with capital for the other 25%. These spreadsheets are designed to calculate all that, but in this case, we don't have to worry about it because the selling company has enough real estate to handle its growth to several times its existing size now. So there isn't going to be more real estate bought. So we only have to worry about the current. So the outstanding balance in terms of the company, the amount of real estate, the value of it is right here. And then month by month, what's going to happen to that value? The value is going to go down, okay? And this is the amount of the loan. Remember, we have a loan that we are going to make, and it's going to be on close. The money is going to come to us. We're going to pay it to the seller as part of the money for the purchase. But now we're going to owe that money. So on the day we borrow the money, we're going to owe $3,279,000. And then starting in month 1, that balance is going to go down. And every payment we make is going to have a principal payment and an interest payment. So you'll see that as we make the payments, the amount allocated to principal is going up. Let me make this bigger so you can see it. Okay. So as we make these payments, okay, the balance is coming down because the payments we make include principal, which is each month going up because it's a level amount of payment that we're making. And then the amount of interest that we have to pay is going down because we have less and less principal outstanding. So the principal is coming down, the interest is coming down, and the amount of payment each month allocated to paying down principal is going up. So all this is getting calculated all the way across here. So all of that is going to end up showing in future sheets that I'm going to show you when we do a total pro forma of the whole transaction. So what you're seeing here is pieces that are all going to come together later on to give us those final numbers that I showed you in the beginning. All right, a couple of other things that we have here is something called a forecast. Okay, we worked with each of these companies. We developed a set of financial statements on the company. And from those financial statements, we learned this information that's contained in here. Okay, so we know what the total income for the companies were for, and this is our buying company. We know what they actually were historically for 2019, 2020, 2021, and what they just were for 2022. We also know that they projected 2023 so that we could look 1 year forward and several years back. So we know the current, we know the history, we know this here, and this is important to history because it lets us determine whether the projection for the future makes sense. In other words, if the company was doing these numbers here, okay, let me make it bigger so you can see it. Okay, so in other words, if the company was doing, as they did, total income, total sales, 863,000, 1,689,000, 3,128,000, and 4,065,000. Now they projected 4,350,000 for next year. If I follow this growth, I'm not going to argue with this number here. It's very realistic in terms of what they did. But if they gave me a number of 10 million there, okay, I would question that. They'd have to prove to me, if I'm going to do this analysis, that they can do $10 million. I'm not seeing that. But if I see this number here, it's very realistic. And I know that they're giving me numbers that they've sweated over based on their history to come up with something reachable and probably conservative for the amount that they would grow here. Because if you look at it this way, they grew they grew almost $1 million in right here in sales. They grew $1.5 million here. They grew 800,000 here. So if they project this, I have a sense that this is low, that they're going to do better than that is my guess. But I don't know. They may see certain limitations coming up next year that they didn't have as they grew in these years here. Then these were their cost of sales. And what we did is we looked at the percentage of their cost of sales relative to their sales. Okay, so their cost of sales This year was 65%, this year was 59, this year it was 76, this year it was 64. They're projecting their cost of sales is going to be 54, which is a little on the low side, given that it's been much higher. Okay, their weighted average was 63% of sales. And so I'm suspecting that this number could be a little on the low side for their cost of sales. So when I meet with them, I ask them, how did they get this? Why is this number so much lower than this? And if they have a great answer for it, that's cool. But if they don't have a great answer for it, we're all going to have a good long conversation until we can agree on what this is probably going to be here. So this is your gross profit, which is the difference between those. And then you've got other income that they've added in. These are their total operating expenses. And we do the same thing for all of their numbers. We look at what were their actual numbers, what are they projecting, and how do they relate to what these have averaged out over a period of time. And the word normalized in there means that when we went through their statements, they took out expenses that they don't include as expenses because they were really for the owner's swimming pool in his backyard. They weren't real expenses of the business. So we do go in and normalize the statements so that they are truly representative of business operations. And then this is the net after tax profit. Okay, so this is their history and this is their pro forma or projections going forward. We do exactly the same thing with the selling company. So now we've got a really good profile of what these companies look like, and we're able to take these numbers here, which are their current year, and we're able to take their projections going forward, and we're able to construct and make certain assumptions for what the future is going to look like, which is what we need to do in order to interpret whether or not we can make a deal or not. Are we going to have the cash flows to pay off the debts that are going to be incurred? Are we going to have the ability to handle the growth curve that they're projecting? Okay, you may have heard of this, but you can grow yourself right into bankruptcy. And the reason that happens is that you have a negative wedge in growing a business. In order to grow a business, you need to have assets. In order to have sales, you need to have assets. And as your sales grow, your need for assets grow. You're going to have to carry more accounts receivable. You're going to have to carry more inventory. You're going to have to have more real estate or different types of other resources that you have to have. And remember, when you buy those resources, you can buy them, but you need to put up a certain amount of that money as capital yourself because you can't finance them 100%. So what happens is that we had to build our model, which accounts for the fact that as you grow, you have this negative wedge that creates the need for more cash in the business. And that cash has to be there, and it can either come from retained earnings, a portion of your profit is used to pay for that, or it can come from raised money that you raise. Okay, you've got raised capital to pay for it. Lots of places it can come from, but it's going to have to come from someplace. So when we build these models, we build them to account for that, and you'll see when I go through it where we actually do that. All right, so anyway, this is what the companies actually look like. Now, I know I'm over time already, so I want to get really to the point where I show you how we do all this. Let me get here. Okay, this is another set of assumptions that we actually work through. And it takes all of those things that you saw on those other tables and other sheets, and it puts them down into a place where we can look at them and see what we used. So our small cap companies are worth 10.5 times their net PE ratio, their PE ratio. The companies that we're buying, this is their sales for, I'm sorry, the buy company that's buying the other company. This was their sales for, let me make this bigger again, I'm sorry. This was their sales for the 2022 year end, all right? And so we would go through all of these different numbers. You'll probably see numbers you saw were familiar. We just consolidated them all into one place. But then we've added some new stuff that wasn't in other places because when you buy a company, you have closing costs, right? So there's maybe a broker that has to get paid or a consultant or somebody that gets paid. It's based on a percentage of the acquisition. There's financing that has to be arranged that costs a percentage, either in points or in fees that have to be paid for the financing you're raising. There's lawyers that have to be paid. There's accountants and due diligence costs. There's some forms of consulting. So on this particular company, we're estimating that it's going to cost us $663,000 to close this deal. That money's going to have to come from someplace, all right? So this then goes through the total funding that's required in order for us to do this. We've got a purchase price of that, a seller carry of $5,160,000. There's cash on close of $15 million that has to come into the deal. There's existing internal debt. There's the new internal debt, which is these amounts here. There's the total internal debt, which is now this number total. There's the shortfall for the cash that's required of $2,190,000. Then we've got to add closing costs to that, and then additional working capital that we wanted to have of $3 million. We want to know that when we go in and doing this, we want to have $3 million in cash sitting in a bank somewhere so that there's additional working capital to grow the company. We also figured that we can't figure this to the penny, so we put in a contingency. And when we round all that out, we know we need to do an equity raise of $6,453,000. If we then take that number, we transmit that into the total number of the internal debt that we want to raise and the equity debt that we want to raise, and that's a total of $20 million that we want to raise. So we round it out, and we know we got to come up with $21 million total. When we do an acquisition, we try to set up what are called unitranche fundings, okay? Unitranche funding. So we're going to have to do a $21 million unitranche deal to make this deal happen, okay? And in order to do that, we're going to have to pay an investor a return on their money that's going to create a lot of excitement for them. And the reason we do unitranche fundings is because if you go to somebody and you ask them for $1 million here and a $2 million there and a $3 million on the building, you don't get anybody excited, okay? Because they're not making enough money on that one deal. So they're not going to lean in for you too well, okay? You want companies that are going to do so well on this deal that they're rolling out the red carpet for you to give you their $21 million. So $21 million is now a sizable financing. You get a lot of funders excited about a $21 million deal. And we're going to set it up so on their equity portion, see on all of the borrowing portions of it, they're going to get the market rate of interest on those. But on the equity portion, they're going to get a 6.5% cash on cash return, which means if they're putting up roughly $6 million of equity capital, they're going to get 6.5% of that year broken down monthly, and it's for the 5-year period of their equity that they're going to have tied up in the company. We're going to buy them out of their equity at the end of the 5 years. So during that 5 years, they're going to get 6.5% per annum cash on cash return. So they got a cash flow coming in from their equity investment. And then they're going to get an appreciation on that of 10% per year. And the way we're going to do that is we're going to have a guaranteed buyback of their equity at the end of the 5th year. And that buyback will give them a compound annual growth rate of 10% on their equity money. So they're going to get an amount of money between cash on cash and equity appreciation that's going to literally double their money. So you'll see if we get into the other numbers here, on their $6 million investment of equity, they're going to make a $6 million profit over the 5 years. So we've created a very exciting on investment for the investor who we're asking to put up this money, because they not only put up the equity money, they put up the borrowed money as well, and they have a really fat deal that they can easily administer, very low administrative costs. They make a lot of money, all right? And then we have this target here where we're going to take this company public within the 5 years, okay? Because this isn't the only acquisition we're going to do. And we're going to presume that we're going to make at least a public offering where the value of our shares are valued at 10.5 times our net earnings at that time, our net profits after tax at that time, okay? So that's where the money is in effect coming from. That's how we're going to motivate the investor to put up the dollars. And when they're investing in this company, they're investing in a little guy who's proven over the last 5 years he knows how to grow a business and knows how to make it run. They're investing in an older company that's now going to become connected with and part of this younger company that already has the stability and market positioning and all the things that the company needs as a platform to grow, including the wisdom of the retiring seller who's going to stay around and make sure that his expertise is made available to this company to help it grow. But you've got a young entrepreneur in the driver's seat with plenty of energy and plenty of track record that says this is going to work, okay? So I wanted you to see all of these essential elements that all come together to do this. And what these calculations tell us is all this money here, it's going to get paid for, okay? It's going to get paid for. And the way it's going to get paid for is through the pro forma, which now takes everything that we just talked about and puts it on a single spreadsheet that starts on day one and follows everything through. I'm going to take and make this bigger for you so you can see it again. You can't see the whole thing now all at once, but you'll see it. So it takes the selling company, it'll take the buying company, it'll take everything, goes month by month, year by year, until you finally get out here to the end, and it tells you what the size of the company is going to be based on their growth rates, what their cash flows are going to look like, right down to, look at this, okay? Unfinanced growth, which you got to have as working capital. Remember I told you about the negative wedge? So that as the company grows, it's got to have more assets. You can't fully finance the assets. So what has to happen is you've got to have additional capital. Remember I said we're going to get $3 million in extra working capital. Why do we want that? Because we want to make sure that the capital is there to pay for that negative wedge that we're going to create as we grow. So everything has been accounted for. And when you go to your investor and you show them that you've accounted for everything, you've looked at every little thing that's going to happen, that's going to build a very high level of confidence in your lenders and your investors to say, we like your plan, we like everything that's coming together, we see the credibility, we see everything, and we see how we make a lot of money and it's attractive for us, and the company has the growth and the cash flow to pay for everything, and they're really happy campers. But that's the beauty of this, and we go through it for the company that's doing the buy, we go through it for the company that's doing the sell, then we construct the consolidated of what does it look like now that it's applied to both of the companies and how the money comes together. We show the investor and the cash that they're putting up and where all the money's coming from and how everybody gets paid back from the cash flows, and then what the investor gets in the way of return on their money, and everybody's happy, okay? And that's the way that we set these things up. Okay, I will try to take some last questions here so that anybody has them, we'll try and answer them. But hopefully you have a pretty good insight now into the scope and depth, that at least that we go into when we put these together. We don't leave anything to chance. The future has its own degree of uncertainty. We can't anticipate the war in Ukraine. We can't anticipate COVID, but we can anticipate what the general marketplace is going to hand us. And we can have enough reserve built into the process that when the world does throw some crazy things at you, unless it's annihilation through a 10-mile wide meteor that hits the earth, the chances are pretty good you're going to accommodate it and survive it. So anyway, so that's what we do here, and hopefully that gives you a lot of insight as to the things you're going to want to do to make your deals come together properly and work. So any last questions? Oh, I see a hand up. Sundee, I'm going to open up your microphone, and I think I am. You're on self-mute. You got to unmute yourself, and if you want to talk, and say hi. Sundee, are you there? Are you there? He may have left for a few minutes. So if he comes back, we'll try and get him on. No more questions that I see here. All right, there being no more questions, then what I'm going to do is go back to my PowerPoint. And hopefully I covered with you these items today. I went through the financial leverage of what we're going to do, the strategy by which we've put the whole thing together, the techniques we've used to do it, including the building of the cosmic bond between the principals so that they have enough cohesion to each other to last through all of the negotiations and everything it takes to piece these deals together, so that there's a kind of a glue there that holds them together while all this is manifesting itself. So that's the process, and hopefully that works for you. Don't forget to type your questions in, or better yet, if you don't have it in by now, just send it to me, question@bizarrefinancing.com. All right, so I want to thank you all for your enthusiastic presence here today. Look forward to seeing you at the next one of these that we do, which are on the second and fourth Wednesdays of each month. The second Wednesday is pro, the fourth Wednesday is for essentials. And until then, I wish you the best of success.